All right, good morning, good morning. So the banks have kicked off earnings really well so far. Yesterday, we had the 0 DTE gamma magnets kind of kick in, and we were drawn to uh, major levels, but a lot of it was done through tech. Today, it looks like the same thing is beginning, but it's coming through finance. And what we're looking at right now is a 1-hour chart with daily pivots. I talk about these all the time, but usually it's in the context of my regular chart and all the other things that are on there that are cluttered. And I say whether or not we have an MDP, a missed daily pivot. The thing is, when I refer you over to go maybe watch some videos on it on YouTube, because I don't want to teach it. It's not my strategy to teach. I don't trade it. When I reference the missed daily pivot, it really isn't valuable for that day. It's valuable for the next day, right? So if I mentioned yesterday that we have an MDP and we actually made it through the whole day without touching that pivot point, the next day becomes important. And I generally reference daily and weekly, but there's daily, weekly, monthly, quarterly, yearly pivot points. So Tuesday, MDP, Wednesday, same thing, Thursday, same thing. And here we are on Friday with yet again, so far, another missed daily pivot. Now remember, a market will generally hit its pivot point about 80% of the time. So when it doesn't hit that pivot point, it shows its true nature at that time. Is it bullish? Is it bearish? How strong is it? So it's really strong when it doesn't even come back and tag that pivot point. But at some point the music stops, right? And you got to make sure you've got a seat. I would be cautious trying to short this market. We are set up for a real awesome trade with that rejection yesterday off of the high right at the end of the day on the 15-minute, giving us this sort of a we'll just call it a 2-bar reversal. I like calling it tweezers, but there's some criteria that says that's not exactly a tweezer. 2-bar reversal is good enough. When we get back up to this point, it very well may be the smackdown. Now, we said the same thing back here, and when we got to it, sure, there was difficulty and we pulled back away from it. We got there again and pulled back away from it, but we finally got through it. And once we did, we Busby. That's just the word that I created so that I don't have to say the sentence that I'm about to say. When we test old resistance and finally break through it, very often we will come back and test that old resistance and define it as new support. That's a lot of things to say when I could just say we Busbied. So we broke through the old resistance, and then we came back and tested the old resistance as support. It held, and we based there, and then away we went. All right, so that's a Busby. Really the accumulation of that, right? Just because we broke out, that's not a Busby. Just because we came back and bounced, technically that's not quite the Busby either. It has to bounce and hold and prove that that old resistance is now new support. If it isn't support and we fall back down, then we never Busbeat at all. We wouldn't say it was a failed Busby. We just didn't Busby. We didn't test that resistance as new support and see that the new support held. Instead, we just broke out and fell back down again. But right now, the key is going to be that gamma level 44.52. And for the SPX, 45.17. The reason I don't normally come over to the SPX and do what I just did is because we really don't need to. It's the same pattern, right? The numbers might not be the same, but if we just hide those numbers on the side of the chart, right, kind of tuck them off where you can't see them, and I turned off the Globex on the ES, the pattern would be the same. The pivot is still the same. And whatever reaction in price we're going to get, that's going to be the same. So, generally I don't go over and give a translation on what the number is going to be for the SPX, because all you got to do is read price, not the numbers on the side. Good morning. Let's go ahead and do the thing, right? So unlike yesterday, global indices are kind of a little bit of a mixed bag. Germany is finally getting a little bit of a pullback. Small caps as well in the US here, a little weak. And then the rest tend to get better until we get the Dow 30. That's your mega cap blue chip cream of the crop, right? Your top 30, usually household names. Everybody would recognize the names that are in there. Maybe not every single name, right? But I bet you'd recognize most of them. Your kids would probably recognize most of them. The highest thing on the list today is the Michigan Consumer Sentiment Index. I don't know about that. Certainly one to keep our eye on. And we have Goolsby, that new Fed guy. There was also an announcement this morning on Bloomberg that one of the existing Fed members is retiring. He gave an announcement. Damn it, for the life of me, I forgot his name already. It's been that kind of a morning. Been really busy, but we're going to be getting quite a bit of new Fed members over the next 2 years. So, this is just the start of it. It's just the trickle. So by the time we get into the afternoon, should be good to go for any of your 0-day plays. The rig count very likely won't have any impact or bearing on the market whatsoever. I worked on those rigs for most of my life. Then the number doesn't change very much. And if it does, usually it will increase first because they'll come out with like a whole new fleet. And then say, just like car recalls, something goes wrong with that fleet and they stack them all in the dirt real quick. That would pretty much be the only reason you would see that number change drastically. Barring anything like a COVID situation or anything like that. And that would be so market moving across the globe that the last thing we'd be worried about is the rig count anyways. So I would never say just ignore data. That's not my nature. I will say it's very likely that that won't come into play. So you should be good for your 0 days in the afternoon. We had a rising wedge and we're now breaking out. Rising wedges are supposed to break to the downside, and that doesn't mean that they always will. The thing is, sometimes they'll break up first, and it's a little bit of a like a blow off top. So the idea behind it, you get something like a rising wedge, price in there, it's supposed to break down, right? Within, say, if we measured that zone from 0 to 100, it should break down somewhere around 70, maybe 75%, right? It should never get into that last 30%. And it's supposed to be a downside break, but sometimes it will break up first to trap all the bulls. and then it'll dump through the entire wedge and break out of the bottom of the wedge. When we have a wedge, you want to measure the widest part of the wedge. So if this is our wedge and price has been working its way through there, you measure the widest part. And then when we break up, don't measure that. Wait till we break down through the bottom of the wedge. And when we break through the lower half, that's where you start. And then you project that downwards 50% and then 100%. So depending on whether you're using this daily rising wedge that is really small here within the last week, or if you were to zoom out a little bit with the weekly chart, maybe get this bigger rising wedge, that is a much bigger rising wedge, right? That thing's been going on since October of last year. We would measure all of this and project it to the downside. There's like a wedge inside of a wedge inside of another wedge right now. And it just keeps on going up. So it's one of the reasons that I'm continuing to stress, don't short this thing just because. That's not a good enough reason. I can't tell you how many times every single day I see someone trying to short something just because it made a big move in one direction. Like, oh, wow, well, look, it went up really fast. I'm going to short that sucker. There's nothing wrong with being contrarian, don't get me wrong. And getting in before you have any confirmation is the least amount of risk that you could ever take. And in fact, with options, you can get a better price being contrarian, right? Going along when the market's still falling, you'll get those calls sweet cheap. Going short when the market's still going up, you'll get those puts really cheap. But you have to be really good at money management, or the LRE wasn't an LRE after all, right? LRE stands for low risk entry. It's only low risk if you actually manage the trade when you're wrong. And if you're using some far out of the money junk to begin with, that's like a snowball's chance in hell that you're going to lose, right? When you sell some out of the money junk, you're supposed to win 90-something% of the time. Look at your delta. It'll tell you your percentage of what your win is supposed to be. But that trash, if you get caught offsides, has no recovery to it and has a really, really outsized loss, real big loss connected to it. So there's better ways to play that game. For today, we have an MDP. We are looking to challenge 45.51. It's yesterday's high. That is anticipated to be a significant point of resistance to get through, not only from a rally base drop perspective, but also just from the candle pattern itself, right? That 2-bar reversal. So rally base drop, this isn't the forum for it, but we can just kind of agree on the fact that there's perhaps some unfinished business here, maybe some traders that got trapped because somebody bought the top, right? And we have to kind of think about how the market is going to respond when we get back up there. So the distal line will be the high. It's pretty obvious. And for your proximal line, really there's 3 ways to do it. The one that has the highest success rate would be to use the body point closest to the distal line. But while that has the highest success rate, it has the least amount of frequency, right? So sure, it wins when you get them, but you don't get them very often. The most common would be right there where I have the line drawn, and then the least, let's see, effective, productive would be where I have the line drawn there, right? The farthest body point from the distal candle. Or say it the other way, the closest body point opposite of the distal. I don't make the rules. volume is light. So I was trading the ES this morning since the NASDAQ really wasn't getting the same love. And noticing, of course, that we were rallying on light volume, lighter than usual. I tend to trade more in the Globex than at any other point in the day. So I'm used to lighter volume anyways, but we were sitting close to 80 at 7:30. That's the benchmark time frame. It's a little light considering what's on deck for econ today. We have a market maker move, which again, it just implies that there's a lot of hedging activity going on. They're buying up they're not even buying, it's the wrong word. They're trading up in the front end. And that means trading up in the front end of options, right? So sure, we're looking at the ES futures, but ES futures do have options on it. And it's from that options chain that we get the market maker move, right? So the zero, let's just scroll this up to where we have the 0 day showing. The 0 day is at 10.8 and the next day out is at 8.7. So that disparity with the front end being higher than the next series out is why we have a market maker move in the first place. Why is it higher? Well, implied volatility within the options chain frequently adjusts due to the frequency of the trading within the options. So if they come in here hot and fast and start trading these up, they will increase the volatility within the options chain, right? And that implied volatility increases the value of the option itself, not its, I shouldn't use the word value. It increases its cost because its value didn't change, right? A can of Pepsi that costs 20 cents to make is still only worth 20 cents, even if we pay $2 at the ball games for it. So the missed daily pivot and the market maker move and low volume with this 2-bar pivot and banks coming out joyous. And the other thing this morning that got my attention is we had based in US dollar Japan and the dollar and the 10-year. We had that nice basing pattern going on, and we were just starting to rally up off of it when the banks reported. And when the banks reported, the 10-year flipped right back over again, started heading to the downside, solidly below that quarterly level of 3.83. So that gives up the whole above 4% thing right there, right? Just getting through that quarterly level was bad enough. Now that we've given it back, I don't think we're getting back up there anytime soon. So that is bullish equities, just right off the cuff. Now, it doesn't mean that it's always going to be that way all the time, every time, forever and ever, amen. But in the backdrop of what we're in and where we've been for a while now, seeing this thing come off of those highs of the 4s and the high 3s, that's going to be bullish equities. So that reversal this morning where it came back down and it's now testing a breakdown to see us get below 3.75 today kind of sustains my belief that we're going to break yesterday's pivot and continue that move higher. Yesterday, we did it with the NASDAQ and gamma trading. Today, we can do it. We can do it with financials. Here's the rub, though. Generally speaking, you have your 3 risk-on sectors: finance, tech, consumer discretionary. It's usually finance and tech with the assist of consumer discretionary. Now, you can do it with tech and consumer discretionary. You can do it with finance and consumer discretionary. You don't need tech. But on those rally days where we don't have tech, it's usually harder to gauge the plays, right? A lot of our tools won't read correctly when some of the biggest names aren't participating in the run. Apple, Microsoft, Google, Amazon, Tesla, right? When those things are sitting out and they're not in the game, then our tools don't necessarily function correctly, right? So say your advanced decline line with 100 names in the NASDAQ, you only need those top 7 names to carry the NASDAQ all the way across the finish line. And so we get really comfortable reading the NASDAQ advanced decline line where it could say 70 names down, but as long as the other 30 have the top 7, we can rally to the freaking moon. On a day like this, it can be completely inverted to where it might say we have 70 names up and yet the NASDAQ will still be range bound, sideways, struggling just to maintain VWAP. All right. So be careful on a day like this where it's just finance. And I've heard some very smart people say that we cannot rally with just financials. I beg to differ, but it's a time frame thing, right? It really is. When two people disagree about what the market can and can't do, it's usually a time frame issue. One is thinking of a smaller time frame or a higher time frame than the other. So we can rally with just finance, but it's usually choppy, nasty, difficult. The follow throughs aren't really good. You end up taking more heat than you want. So right now, the really big deal we want to keep our eye on is that 10-year. We want to see if it's going to give us this bottom and support itself. Maybe get a little bit of a bear trap here where we break this pivot, because you can see, think about the front running that went in here, right? We had a double bottom forming. Liquidity resides on the other side of the pivot. So we expect the double bottom to break that pivot point, come lower, trap the bears, and then squeeze them in a break to the upside. And we didn't get that. Instead, everybody jumped in early. So that liquidity is still there. We never got our play. And now we've got this situation where we got a little bit of a megaphone pattern, but we also are now forming like a triple bottom. It's still the same thing, whether it's a double, a triple, a quadruple, it doesn't matter. Liquidity resides on the other side of the pivot. When we break through this, we're going to expect them to expand a little bit and then flip that thing over and run it back up. The problem is, how do we know when it's a double bottom? And how do we know when it's a true breakdown and we're really breaking down and we're really going to continue to the downside? I tend to use fibs for that, but a good example of what that question kind of leads to is this right here. So if we had a market that set a low, came up off of that low, and then now was running back towards the low, perfect example of a double bottom, right? We would be thinking, oh, okay, it's going to trap the bears, rally back up, and then dump it on their head, right? Just like that. Only this got hung up and structure couldn't continue to move and ended up breaking down anyways. And so if we ignore all of this to the left and we think about this as a pivot point, double bottom, when we come down, we're going to expand through, complete the double bottom, trap the bears, rally back up. It didn't trap anything, right? It just kept on going. So how do we know when it's going to do this versus when it's going to do that? Yeah, that's the rub, right? So something really generic. I mean, simple. No matter what broker you have, as long as you have drawing tools, you can do what I'm about to do. It doesn't have to use, like Fibonacci's and quant drawing lines. It doesn't have to be something like that. You can just take a box and draw the box, right? And then you can draw the box in 50%. So there's half the box and you can draw half of that box again. Now I didn't measure that. It's not perfect, but this little box right there would be 25% of the range that I just measured. If it's going to reverse and come back inside, it really shouldn't go beyond that. Now, since I didn't measure it perfectly, we kind of winked a little lower than that box anyways, but that's how you can do it if you don't have drawing tools and fancy stuff, but you can draw, right? Otherwise, something like a fib level with the 1, 2, 3, 6. Now I have a line here instead of candles. We would want to know, hey, did we close below that 1, 2, 3, 6 or not? And then rally back up. The second time would be the same thing. Just snap it from the low. Here I'm using quadrant lines instead of the fib lines, but you can do the same thing. Just add it. Say the 1, 2, 3, 6. Notice how we broke through that 1, 2, 3, 6 with a vengeance. We just kept on going, and there was no slowing that thing down. So it's not perfect, but it's a good rule of thumb. I think Investors Business Daily had a 10% number, something like that. I never really bring it up because I'm a little shady on the details. It might be 7%, it might be 10%, but I don't know. The percentage number I would believe would vary from product to product. So I kind of like using the fib levels instead. But so now we've got the same situation, right? We got this double, now triple bottom setup, and we're going to be breaking through very likely, it looks like. So we want to know in that expansion to the downside, at what point is this going to be too much? Has it gone too far? It should not get to 3.73, right? It should hit that pivot point inside there, that fib line that I don't have turned on. It should hit that and turn back up before then. If it gets all the way to 373, it's just going down. It's not going to be a bear trap reversal. That's simple enough, yeah? Yeah, you like it. With this many days in a row having not hit our daily pivot, should we reject across the high of yesterday of 45.51.5? I'm going to target that pivot point today. That's going to be my downside target. And yeah, there's a lot of stuff we would have to get through to get to that target. Right. So here's a smaller version of it's not even really a rising wedge because it's a flat top wedge, but you can measure it the same way, right? You measure the distance from its widest point, which happens to be we'll call it 0.2 just for some easy numbers. Wherever we happen to break down from, because right now, we're still in the breakout point, we'd have to come back down, break through the bottom of it. We would project that same distance to the downside, 0.2. And that gets us to 45.28.5. Right through that daily pivot point, plus some. Right now, we're just very extended past VWAP. So if you wanted to do it in stages, then first target the VWAP, then target the RTH open or the Globex open, get through the voodoo line, get through our own Globex low, and then get through the daily pivot point step by step. I'm really comfortable in the idea that if we do reject here, we're going to hit that pivot. The big issue is, are we going to reject there? Now, if we don't reject there, we can actually get to 46 today. It sounds crazy, doesn't it? We can get to 46. Thank goodness I sold off those MES calls that I was holding. I had some short calls. And when you're selling the calls on the ES and the MES, it's a really easy trade. Just kind of keeps your capital tied up for you when there's no play that you really want to get into at the time. So you put time and price together and you say something like, hey, you think we're going to go to 4,800? No? Okay, well, let's sell a call up there. But in what time frame? I mean, you think we're going to go to 4,800 today? No, no, we're not going there today. Okay, well, we could just sell a call today, right? Well, that wouldn't make any money. How about at the end of the month, at the end of the quarter, at the end of the year, right? You ask that question and then you go in and you look at the calls for that time frame. So do I think we could go to 4,800 between now and say the third Friday of the month? Oh, that'd be the 21st. So we can go in, and price the third Friday of the month. On Thinkorswim, it always sucks they don't break these out as nicely as they do, say, equity options, but let's just target that one right there. Well, there's not much money in that one, but it would still show the point. 4,800, there's no money there. 10. Now, options on futures are different than options on equities. This isn't the credit you would get. You have to use whatever point you're trading. So if we were in the NASDAQ, that would be, $20 a point. We'd multiply this by 20, but it's the ES. So we'd multiply that by 50, and that would be the credit we would get for that trade. But still, it's a pretty simple concept, right? Do I think we're going to go to this high by, say, like the end of next week? Sell that option. Simple stuff, right? Or sell puts. You think you're going to 38.40? No, sell a put down there. Naked. Don't even bother with spreads. The buying power reduction for selling puts naked or selling options naked in the futures is way cheaper than, say, selling a naked put on SPY, where you need $42,000 to do it. This on the MES, you need like $1,500 to sell a put or to sell an option. Maybe $2,000, maybe $2,000. 2,000 is better than 42,000. For those traders that like to do sell to open stuff, because you don't necessarily have to be directionally right. Selling out of the money junk on Apple or Microsoft or whatever, there's just really no premium there, right? And then you don't really get much of a trade, and you're still close enough the price can hit you frequently. But when you're at like all-time highs or say last year's lows, I mean, you're and it's naked. You don't have to worry about being in a spread, so it has defense to it. That's a much better play. I wouldn't go that far out, by the way. I was just using those for an example. So Bitcoin had some news yesterday, and the thing just went bonkers, right? That's a completely scientific term. But we're off this morning, down more than 1.5%. The China ADRs also down more than 1.5%. So this little pop that we're getting this morning, it's all the banks, right? They can lift everything else. It can cause a rising tide scenario when we get that 10-year falling, and right, we get US dollar Japan easing back, breaking down through that base that it just built. You get the dollar starting to fall again. We can get all these sectors moving, but that's going to be kind of the tell that you'll have that we're going to break out and really go, is that all those other things are going to start joining the run. So it's that rising tides scenario. If we don't get that and it's just finance, we could have this really divergent day where the NASDAQ drags its feet and doesn't even get into the game at all, and the ES does all the work. Kind of like yesterday. The NASDAQ was doing all the work, and the ES fought it, kicking and screaming the whole way. Sure, it went, but there was nothing nice about it. Take it over to the KRE NY Fang, and you can see how the banks yesterday stalled out before 11, and really they got under VWAP and stayed under VWAP until nearly 2 o'clock. So we were getting no help out of that whatsoever. And yet, if you see what was going on in the NY Fang, so now today is very likely going to be just the opposite. It's going to be finance doing all the work, and the Fangs kicked back, not really getting into things. Notice, and I pointed this out yesterday, we had that fork pattern, but it wasn't led by the green line. And when you don't have the green line leadership, then you're going to have these kind of choppy, difficult, unsustainable, it just keeps going kind of things. And it did. I mean, it just kept on going. So you run it. there is a company that focuses on that 0-day gamma explosion stuff. They've got proprietary tools specially designed to do just that. I caught a picture of it yesterday. I wanted to point out how crazy obvious it was. You know, as some of the tools that are out there, they're a little complicated. You damn near have to get a degree to figure out what they're trying to tell you. You got to go to their classes, go to their courses, try to figure it all out. And then sometimes the signal is so obvious that it's like, okay. So it doesn't quite look the same as it did yesterday in the picture. I'll get logged in here. Maybe it'll look better then. Yeah, it looks the same now that I'm logged in. You see at 1 o'clock, that green line just shot up and magnetized across there. These are 0 DTE flows, right? 0 DTE GEX, market DEX down here, and then the 0 DTE flow. I mean, these things are specifically designed strictly for 0-day trading and to identify days like yesterday where it's just going to keep going and going and going and going. Now, yesterday was a tricky, kind of a nasty run because we didn't have both sides working together, but tools like this are still available that kind of give you the nudge to say everything's fine. You know, it's doing what it's supposed to do. Trust the system. Take another run at it. Maybe you got stopped out, you know, or you took profits at an appropriate level and it seems like it's going to keep going. You're going to go in and try to get another bite of the apple. These are telling you go for it. They're not always so clear, right? But they do have great videos on YouTube on how to use these tools. They continue to come up with new stuff all the time. And then when it's new, they'll just straight up tell you, hey, this is new. We're not quite sure how it's going to act. So yeah, here, play with it and let us know what you think. I kind of like that, right? Because then it's a collaborative, everything, everybody's working together to try to figure out those new tools. So we got nat gas and we've got banks, and that's not enough, right? We do have the fangs, we do, but it's light, right? They're not even at a 0.5% yet. They're getting close. We're kind of jumping around there a little bit. And that's my homemade ETF for the fangs because the NY fang doesn't open until 9:30 and we can't use it in the pre-market. But on Thinkorswim, you can make your own, you know, indexes and ETFs. So I just put that index together. It's nearly at a 0.5%. The problem is while that's up and it just now got to a 0.5%, banks are up, you know, more than 1.25. So we do need them working together. Right now I'm looking for semis. There they are. All right, so semis are up too, just not very much. If we're going through the checklist, then we've got to take a look at pot stocks, semiconductors, airlines, right? We want to go through the gauntlet. I was curious about what the volatility looked like in the bonds, and it's really dropped off, right? But we're still holding above that 100, so it's fine. Never mind. Never mind. No, I mean, hey, that's a fair question. When it comes to earnings, I generally don't try to guess what their earnings is going to be. I would rather trade the run up into earnings or the move after the earnings. And there's a lot of data on how that plays out. If you want to be an earnings trader, It's kind of a niche, right? Then you want earnings data. And Earnings Whisperer, I think, is kind of the king of the group. I'm sure there were other products, but it's the first one that comes to mind. Earnings Whisperer. Yeah, they've got different tier levels. Like access to different parts of their product. It's not bad. That would be if you actually wanted to maybe trade the report itself. So what we're looking at here is semiconductors. We topped out and are up again this morning, just not by very much. If we were to connect these last two pivot points, the trend line is so far away that, very likely not going to hit it today unless we get another sustained rally, right? If we get more of yesterday. Bringing it out on the weekly, we're just getting through that 156 area, but the week isn't done. So the fear or the concern is that we're just going to fade back in. But we were IX10 for a while. So we're just starting that new leg, right? That new breakout. It's interesting when it comes to buying, say, 52-week highs. When I was newer, I was really uncomfortable trying to buy something that was already at highs and continuing to go up, right? Like why would I want to do that? And then I would see places like Investors Business Daily put out, like a tweet or something saying that X product, it just broke through a 52-week high and that this entire zone up here is a buy point, right? And they'd have like a 1 or 2% zone that makes it a buy zone. I used to think this was user preference, that some traders sell the highs right there and that others are going to buy the highs right there. But it's really a step beyond that. If you dig into IBD, Investors Business Daily, they only look at companies that already have institutional backing, so they can see that it's had quarter over quarter increased institutional participation. That is actual, numbers that you can put your fingers on. It has that. It usually has a good product, good money management, a good CEO. It's a good company that is expected to continue to do good. And then it's breaking out at 52-week highs. That's the difference. If you're just trading some no-name junk company that you don't know anything about and it's breaking out at 52-week highs, yeah, good luck, right? It's 50-50 coin toss. We're looking at an ETF, so we're not even looking at a company, but it's representing semiconductors. We can go in there and look at, say, NVIDIA, Apple, or not Apple. It makes its own chips. AMD, Taiwan Semiconductors, kind of go down through the list. I don't think they're done yet, but certainly you're going to have to deal with some resistance because we're there. I just don't think they're done, right? I don't think any of this stuff is done. It's just the flows are too strong. For the week, yeah. Yeah, I can agree with that. All right, so this chart is kind of trying to represent that pre-market run and then, or the pre-earnings run, and then the move after the earnings. And the statistics across the top kind of give us an idea of how this particular company performs for earnings, right, over the last X period of time. And I've got the chart set to 2 years. So we've got 8 earnings to evaluate. JP Morgan, for example, has beat 5 and has missed 2, and it's not catching today's. So before today it happened, right? We got all these stats. And it's this run up that I was referring to. So you trade the run up into earnings, and then it reports, and you trade after earnings. So if the report was really good, really bad, whatever. Generally speaking, the more eyeballs on a company or on a sector, the better it's going to do in that run up. With the China ADRs down this morning, that kind of sets us up for a 0-day play in a lot of those like Baba, Baidu's. If the premiums are already crazy expensive because of the move that it's made and the elevated volatility, why not run a 0-day at yesterday's high? I know, they're not going to be big monster trades, but if that's where we can find a little bit of volatility, yeah, I mean, it's at 67 and next week's is at 45. So we got a good size market maker move. Yesterday's high, 152.31. You got 152.50. $2.50 spread for 81 cents. And we'd be looking for this to fail to maintain yesterday's high, right? Fail to break through and get above. So we could go that route. Just keep in mind that these prices aren't real, right? When we get into the open, they're not going to be this. It's probably going to be less than this because we're down now. The bid and the ask is between 150.74 and 151.30. So, and then, you got a pretty wide spread here too. Got Microsoft at that significant resistance level. Third time's a charm, maybe. TRB set up an Apple that stalled out. And we're just talking about for the end of the day. Speaking of, we've already got next week's lines. And one of the things that we want to do with those lines is identify, is next week projected to have more volatility than the week that we just had? And are we closing this week inside the box? I'd say no. We'd have to make some pretty good moves to the downside today to get back inside the box. Just copy this box and set it on next week's lines. So far, they're in the same range. So what we want to know by the end of the day today, where these things set, because right now they're not set in stone. They're going to move with price at 15 after 4. Then they'll lock into place, and that'll be the range for the new week. We want to know if it's wider or narrower than the week that we are in right now. We're 4% above the 10-week. That's not exactly the most extreme, but we are getting into an area where we are really going to be considered overbought. Have we moved too far, too fast, and is it going to be a good short? 4% away from the 10-week, that's getting into a little bit of an overextended If we look back and ask, well, have we gotten higher than that? Sure. Back in that recovery phase, after we dropped down into the March lows during COVID and ran back out of it, we got above 5% back then, 5.5%, you know, kind of the line in the sand. So we're only at 4. 5 is getting into like flashing lights and alarms and sirens, but we're there. We're at this level where we are going to anticipate a pause in price. It doesn't have to fall, right? I want to make that clear. I'm not saying the market's going to fall down. I am saying it's very likely going to stall or call a timeout and let that 10-period moving average get caught up. So it would look something like this, right? Where we just aren't setting new highs, but we're really not breaking down either. Or say like this, where we just stayed there, right? We didn't do anything. So I'm not talking about, you know, rejecting and dumping like that, because that's not on the cards, right? There's nothing that we have that says we're going to be doing that. Nothing, especially with the banks coming out as positive as they are so far. And that August high of last year, I mean, that's over. That's done. Now it's really solid support. So can't really say that it's a bear market rally anymore, right? It would take some really negative news. And unfortunately, there is some really negative news. There's a lot of tools globally that says inflation is not dead and it's coming back with a vengeance. But we'll deal with that when the time comes. For today, guys, keep your eye on finance. If it starts to fade off the KRE and we don't get back up with the NY FANG, we're going down. And price wise, I think it's really going to start with a rejection across yesterday's highs with the ES. If we start to see the other names come into the game, semiconductors, your mega cap tech, then we could change that and go for another bullish continuation day, right? See how the 10-year is starting to head back up. That's going to be difficult for equities. Got the ES testing against that high that I had talked about. So if that's going to be our rejection, we get the rally in the 10-year, we get the rejection here, the dollar starts to make its way back up, and US dollar yen continues getting through this pivot point here and starts pushing back towards 39.5, 139.5. That's what I got for you guys. Be careful, be safe, have a good weekend, and I will see you all next week.